Welcome back, everyone, to this week's Forex Weekly Review Explainer. I'm absolutely thrilled to have you here today because, well, between July 20th and 24th, we just witnessed what I can only describe as the ultimate macroeconomic heavyweight match. Honestly, if you've ever wanted to understand exactly how geopolitical shocks, central bank messaging, and hard economic data all collide in real time to move the markets, you are in the exact right place. We're going to break down this epic macro tug-of-war step by step, using the raw data and market realities to show you how this wild week actually unfolded. Here is our battle plan for today. First, the global currency leaderboard. Second, the euro's roller coaster ride. Third, the stagflation shock. Fourth, the hawkish rebound. And finally, number 5, the week ahead and outlook.
Section 1. Global Currency Leaderboard. Setting the stage.
Looking at the broader landscape, the divide right now is incredibly stark. Up at the very top, the undisputed King Dollar claimed the #1 spot. Why? Well, it was driven by a powerful 1-2 punch of surging safe haven demand from global tensions and a serious reevaluation of rate hike expectations. Right behind it, the British pound just kept steady and strong. Now, sitting right in the middle, we have the euro, which was defined entirely by massive volatility. We'll get to that in a second. Down at the bottom, the Aussie dollar really struggled as a weak commodity currency, but man, it was the Swiss franc that took the crown for the absolute weakest performer of the week, just steadily crumbling under market pressures.
Section 2. Euro's roller coaster ride. Extreme whiplash.
60 points. I mean, think about that for a second. The euro swung a massive 60 points on the strength index in the span of just 5 days. In the Forex world, a swing of that magnitude over a single trading week is the textbook definition of a roller coaster. It tells us that the market was aggressively pricing in two completely opposite economic realities, literally within hours of each other.
The timeline of this thing reads like a play-by-play sports commentary for a V-shaped recovery that honestly caught so many traders completely off guard. On Monday, the bottom just fell out. The euro crashed straight to its weekly low right out of the gate. By Tuesday, we started to see a gradual, tentative stabilization as that initial panic kind of settled down. But then Thursday arrived. The European Central Bank decision hit the wires and triggered a rapid, violent rebound. And just to top it all off, Friday's PMI data extended that recovery, allowing the euro to basically claw back the vast majority of its earlier losses.
Section 3. The stagflation shock. The downward force.
So what dragged it down so hard? A geopolitical catalyst acted as a direct economic trigger this week. It was like falling dominoes. Step 1. We saw a real escalation in US-Iran geopolitical tensions over the weekend. Step 2. Because the Middle East is the world's energy artery, those tensions immediately pushed Brent crude prices up, breaking right past that critical $90 per barrel threshold. Step 3. That $90 oil instantly terrified investors with the prospect of Eurozone stagflation. And Step 4. That fear materialized into a massive, immediate sell-off of the euro. It's a purely logical chain reaction, where international headlines directly, and I mean directly, dictate capital flows.
Now, the crucial point here is understanding exactly why $90 oil is so terrifying for Europe. Stagflation is an absolute economic nightmare. It's what happens when you combine slow growth, high unemployment, and rising inflation all at the exact same time. And because the Eurozone is a net energy importer, they have to buy their energy from the outside. So when oil spikes, it simultaneously crushes their economic growth by driving up business costs while also spiking inflation for everyday consumers. It is without a doubt the ultimate macroeconomic trap.
And to make matters worse for the euro on Monday, there was another massive weight dragging it down. The market was heavily betting that the ECB, after already hiking rates in June, would look at this fragile, struggling economy and implement a policy pause in July. The overarching expectation that the central bank would just sit on their hands while inflation flared up really compounded the downward pressure, leading traders to just dump the currency across the board.
Section 4. The hawkish rebound. The plot twist.
Then came Thursday, July 23rd, and the ECB technically did exactly what was expected. They held rates steady, but the message that accompanied that rate pause, it completely upended the market's bearish narrative. See, it wasn't the action itself that shocked the market, it was the incredibly aggressive, hawkish tone of the press conference that followed.
The shock factor was delivered directly by ECB President Christine Lagarde. She explicitly warned that the energy shock from the Middle East hasn't even fully hit the economy yet. But more importantly, she stated flat out that Eurozone inflation will remain above their 2% target until the first half of 2027. This single, powerful statement completely erased the policy pause narrative. It basically told the market, hey, we are not backing down from inflation, which instantly revived the euro.
Almost immediately after that, the whispers started. Following the press conference, reports surfaced that ECB officials were actually already preparing a 25 basis point rate hike for September if the inflation outlook didn't improve. This rumor of imminent tightening injected massive bullish momentum right back into the market. In the blink of an eye, the dominant narrative shifted from a fearful stagflation story to an aggressive hawkish tightening story, forcing all those traders who had shorted the euro on Monday to aggressively buy it back.
But look, talk is cheap, right? Well, on Friday, the hard numbers actually backed up the ECB's tough talk. The Purchasing Managers Index, or PMI, dropped for July. As a quick refresher, anything above 50 indicates expansion. Manufacturing surprisingly landed at 52.0, and services came in at 51.6, both comfortably in the expansionary zone. This provided some rock-solid fundamental backing to the ECB's hawkish tone.
Breaking those numbers down even further, that services PMI expansion was absolutely huge because it came after 3 straight months of contraction. Furthermore, the German economic engine, the real powerhouse of the Eurozone, actually beat expectations. This was really the final puzzle piece for the week. The fundamentals proved that the Eurozone might just be resilient enough to handle those higher interest rates, perfectly aligning the economic reality on the ground with the central bank's hawkish monetary policy.
Section 5. Week ahead and outlook. The new equilibrium.
The epic clash we just analyzed pits some massive macroeconomic forces against one another. On one side, you've got the bearish forces, real stagflation fears and ongoing geopolitical energy shocks that are actively threatening growth. On the other side, the bullish forces, a surprisingly hawkish ECB ready to tighten, backed by a surprise PMI economic recovery. But remember our leaderboard from the very beginning of this explainer? While the euro fought back bravely against these bearish forces, the US dollar's safe haven status, fueled by those exact same geopolitical risks, still ultimately capped the euro's absolute ceiling. So, the tug-of-war is balanced, but it is incredibly tense right now.
So, as focused learners, here are your marching orders for next week. You need to keep your eyes peeled for 3 specific catalysts that will determine the winner of this next round. First, watch for any follow-up statements from ECB officials to see if they actually maintain this hawkish line. Second, heavily monitor the evolution of Middle East geopolitical risks. Oil prices remain the ultimate wildcard here. And third, keep an eye out for upcoming core economic data releases to see if this week's PMI recovery was the start of a trend or just a temporary fluke.
I want to leave you with this final thought to chew on over the weekend. With the US dollar firmly retaining its safe haven crown during times of crisis, can the euro's new hawkish momentum actually survive if this global energy shock continues to escalate? That is the million-dollar question. Thank you so much for joining me for this explainer. Keep your charts updated, stay sharp, and I will see you right back here for next week's market action.